Welcome back, guys, to our value investing channel. Today, I'm glad to have as a guest Daniel Kotas. Hi, Daniel, how are you?
I'm very good. Thank you. Thank you for the invitation, and hello everyone from my side as well.
I have Daniel as a guest because today Daniel is going to speak about Metlife. It's a company that he deeply studied in because Daniel is a value investor himself. We are going to have some presentation from Daniel right now, and we both are a value investor, and we are in the platform as eToro. You will find down below in the description our public portfolio because both of us has some public portfolio on that platform, and both of us we have been awarded as a value investor. That is not really easy to do because we are just a group of 10 up to hundreds people that tried to achieve this value investment badge. So, Daniel, do you want to introduce briefly yourself?
For sure. Thank you very much. So just for a brief introduction, as Dominica said, I'm also a value investor. My biggest role model is obviously Warren Buffett, but also others as Charlie Munger, or some would consider him growth investor, but I consider him really somewhat of a growth investor, Peter Lynch. And I try to focus on companies which are both well-established, well-known, have a strong brand, but also still have a big or huge growth potential. And obviously, I'm looking for strong financials, well-managed debt, conservative management in the sense of cost effectiveness, margins, etc. So I would really sum up my approach as Warren Buffett said it, looking for excellent companies for a good price. And so one of those companies I would consider excellent for a good price would be Metlife, which is an American insurance company. And just from the beginning, as I said, I focus on well-established companies. When you say Metlife, everybody's like, yeah, I know that's an insurance company, right? And yes, that's exactly true. They're very well established, but we'll get to that point later. So this equity research is from the 24th of December. Yes, I work also on the Christmas day. So it is not as of today. It is like 1.5 months old, but still it is very relevant. The financials don't change that much. Only the price changed a little, but we'll get to that. So let's begin with a short overview. As I said, it is an insurance company and it focuses on life and health insurance. Just for general views, so not many people are maybe familiar with financial or insurance companies. The most general way to divide them is into life and health insurance companies, and then so-called P&C, which is property and casualty. That is for your car, for your house, whatever. So MetLife is in life and health, and it operates mainly in the United States. United States is the most developed insurance market in the world, both in the number of clients, in the number of companies, and also by the standard of developed markets, regulation, etc., etc. But MetLife also operates in other countries or continents in Asia, mainly in Japan and Hong Kong, then in Latin America, also Argentina, Brazil, and EMEA, so Europe, Middle East, and Africa. That is a very small position there. It is more of a niche insurance company. We'll see what the future will bring. And then there is the category of MetLife Holdings. That is basically everything else. That isn't really a geographical segment, but more of a like a category that doesn't really fall into any other. So it's also in the US, also in Asia, etc. So the life and health categories within themselves are the most common ones, So the standard like when somebody gets injured, or life insurance when somebody passes away, they get paid in some money. So all these standard insurances MetLife does. So its portfolio is very well diversified, and it can capture a large number of clients because it has such a huge offering. When we go over to the competition and industry itself, we can see that within the life and health insurance, MetLife is among the biggest ones. The main competitors in that segment are Aflac, which is a Canadian insurance company, Prudential, and Manulife. The graph you can see is market caps of the mentioned companies, and as stated, MetLife is one of the biggest ones. At the time of the analysis, it stood at 42 billion US dollars. It is a little bit more because the price has increased since then. But still, so $42 billion is a very big company, which is well established. It has a lot of financial power, but still there is a lot of room to grow with, because the idea of value investing, when you find a company which is, for example, $500 billion, in order for you to make 100% on your investment, the company or the price has to double its market cap, which from 500 billion to $1 trillion is just very, very difficult. But when you find a company which is 40 billion, which is well established, the road to, let's say, 80 billion is not so complicated. And as we saw on the previous slide, the market shares in, for example, Asia, Latin America is still relatively low. So there is a lot of room to grow for the company, which I find really great. The industry itself, we have to understand how the industry operates and what it is characterized by. So we understand the business well. One of the key characteristics is that there is a large number of competitors. That is a very important fact. As I said, it operates mainly in the United States, and the number of competitors very, very big. And since MetLife is very big itself, that gives it a competitive advantage, because it is just for a client or for a new client, it is just easier to choose somebody well-known, somebody well-established. Then the capital requirements are very, very high in insurance companies. It's a financial service, of course, and you have to maintain just a large pillow of cash, so to speak, to be able to pay, to pay when the event of insurance happens. So it is also said that financial companies are balance sheet heavy, because they just keep enormous amounts of cash, and also their liabilities are very high because all the premiums that the clients pay are accounted for as liabilities. And right now, which is also very important, and we'll get to that fact later also, is unfavorable economic conditions. Unfavorable in a sense, that might sound weird because we all hear all the time like economy is booming, not during COVID, of course, but before that we were hearing that economy is booming, everything's doing great, etc., etc., but not necessarily for insurance companies, because for people who are maybe little unfamiliar with insurance companies, how they operate is they collect the cash, they collect the premiums from their clients, and now so the cash is not sitting just nowhere or in the bank. They have to invest it. And they have to invest it in a very safe way, so they are sure that they will be able to pay later on. So they invested mainly in fixed income, which is just basically bonds or debt, you know. And because the interest rates have been so low for so low for such a long time, it's been very hard for insurance companies to make any extra revenue or any extra income on those fixed income investments. And that is very unfavorable for them, but we'll see how MetLife deals with that. So some competitive advantages of MetLife itself, as I already mentioned, is the leading market position. It is just one of the market leaders, which is great for a company which doesn't really have the power to differentiate the product itself. Because when you compare insurance companies to companies such as Apple, let's say, or Coca-Cola, or maybe some physical product, it is just easier, you know, to make a new design for the iPhone, give it some new features, and just differentiate yourself by the product and give customer value that way. When you have an intangible product, which insurance is, which is basically a service, and which basically you don't ever use, you use it once, maybe in a couple of years, you don't really get sense of some brand loyalty, you know, or the differentiation of the product itself. So the company just has to be really strong and well known in order to capture the customer and kind of make them loyal. Another competitive advantage is a strong balance sheet. We'll look at the numbers later, but I can assure you beforehand that MetLife is very, very strong financial wise. They're managing their money really well, so to speak. Strong brand, that is what I already mentioned. But one thing I didn't or haven't mentioned yet is transfer to fee-based business model. And that is extremely, extremely important. And that is linked to the unfavorable economic conditions I was speaking before. So what they are trying to do now, that instead of getting the premium, like signing the customer and then investing the money and earn income that way, what they will try to do is transfer to the fee-based model, meaning customers themselves will pay some regular fees and substitute the income they would have otherwise earned in the fixed income. So atop of paying the insurance, like the premium monthly or yearly, they will pay some little fee on top of that, and that's how MetLife will keep earning regular money. So I think that is really important. And you can see this trend in a lot of other financial companies, which are kind of dependent on the market and the interest rates. So the transfer to fee-based model, I deem very important step in MetLife's life and its profitability, which is for us as investors extremely important, of course. So yes,
Daniel,
go ahead.
I just would like to ask, in as long as their strong position in the market could be a factor of the risk, the problem that to make new customer, the only way to compete with their the other brand, it's about price, or could be even something about service that could make the difference.
Sure. That is actually the difficult part, I would say, about the insurance business. And that is also linked to what I was speaking about the differentiation itself. So they have to compete for price. That is very true. And that's why the fee will have to be moderate, so to speak, or not too big in order to be competitive with price. Where I see where MetLife will be able to compete price-wise is because of their size. They just have savings from the size, or they're so big that they can be more efficient than smaller companies. They do not have to spend so much on marketing. They do not have to spend so much on overhead. They have just lower costs for administrative operations and so on. So it's like economy of scale, so to speak. And that is very true in service and insurance companies and financial services companies mostly. So that's why I think in the future, the number of insurance or financial services companies will actually shrink or will decrease exactly because of this, because companies will have to compete with price, and the smaller companies, the local ones, maybe in the United States, like state insurance and so on, just won't be able to compete with big brands as MetLife, as Prudential, as Aflac, and so on. So hope that answers the question.
Perfect. Absolutely. Yes. Thank you.
Great. My pleasure. So a short overview of SWOT analysis. So strengths, weaknesses, opportunities, and threats, which we kind of got into a little. So strengths are definitely the financial stability. I mean, I keep repeating it, but for financial service company is just alpha and omega. It's just so incredibly important. Because when you're an insurance company and when you collect the premiums, of course you're regulated and so on, but it may seem tempting, like you get all the cash and you're basically not spending it that much. So, it may be tempting to, I don't know, for the CEO to say, okay, we're going to acquire new companies. We're going to be really aggressive, but that is dangerous. You know, you have to be financially stable to be able to pay in the future. I mean, of course, executives of insurance companies know this, and they're smart people. That's why they are managing the companies who are not. But it's just some companies, for example, the smaller companies may get this tempting to be able to compete in the future. They just have to establish themselves. So yeah, moving on, it's the brand. We spoke about that. It's just when you say MetLife, everyone will say, oh yeah, that's insurance company. I know that. That's good. And the market position. The weaknesses are what we also mentioned is the sensitivity to interest rates. When you read their their annual statement, which is about 350 pages long, so it's not that fun. But they keep repeating it as well. It's like we are sensitive to interest rates, but we are moving to the fee-based business. So this weakness will be prevalent. It's not an overnight issue to move to a fee-based business, of course, but they will get there. They will get there, and I think they will cure or solve this issue. And those are also the opportunities. So it is the transfer, and also what I mean by more advanced insurance models for better margins. You can see that the big data is everywhere, so to speak. For example, Amazon or Google, they're using their information to tailor, let's say, the ads or the offerings. And so will be true for insurance companies, because how insurance companies make money, of course, they're able to calculate on a large number of on a statistics, or they have just a lot of information on some cases, just the clients and so on, and they're able to calculate how much a client will have to pay annually or monthly, so that even if one of them or some of them will get the insurance money, the business will still be profitable. And with advance in data science, I think the insurance companies will be able to tailor and develop more advanced models to calculate these insurance. It's just called like insurance mathematics, right? They'll be able to calculate and just tailor the insurance for each individual client more. So it's twofold in a sense that they will be able to maybe predict or see individual clients like, okay, this one is not as risky, so this client will be able to pay less. That's why they will be more competitive. And the second fold is that overall it will make the business more profitable. So that is very, very important. The data science and the data analytics will just push the company forward, and only really big companies with a big stack of cash, because all this is very expensive, and all the big companies will be able to afford that.
I don't know if you maybe did some work on that, but I can absolutely understand the fact that this managing those big data could improve the product. But as you said just now, it's quite expensive to implement those big data and everything. Then when it's done, okay, perfect. We have everything done and we can take advantage from it. But could be something that will go to impact margin on this company.
I think for sure, because depends on the time frame we're talking about. But in the long-term general, I think it should definitely improve the margins, because once these economic scales kind of manifest themselves, and these data science projects, so to speak, get dissolved and like depreciated, I think the cost shouldn't rise that much, and the revenues overall should increase also because of, or let's say the cost should maybe even decrease a little because they will be able to manage the insurance better. But most importantly, I think the revenues will increase at a higher rate. That's why the margins, I think, will definitely have to improve. Or I would hope so, so to speak.
Perfect. Thank you.
Yeah. And one threat, which is, I think, always present in every business, but in insurance business, especially, is inability to acquire new clients. I mean, of course, right? So, that is more in the US. A lot of people in the US have, but still there's a huge chunk of population which doesn't have insurance. But with the competition, I think it might be difficult for companies to acquire new clients exactly or precisely because of the reason of the difficulty to differentiate yourself by the product, because the product is just very hard to kind of, it's intangible, right? But with this comes also new opportunities. So the acquisition of the client, because traditionally clients are acquired by some insurance agents which kind of sell you insurance, and a lot of people really don't like that. You know, it's kind of sensitive to them, and I think there's a huge opportunity to kind of expand on that and maybe improve this model of acquiring new clients. And this model, why maybe not will be so present or so important in the US, I think as Metlife will be moving to new market, to emerging markets such as South America, because most people in South America don't have insurance, life and health insurance, let alone property and casualty, but also in Southeastern Asia, Africa, 100%. Those are just huge untapped markets for the decades to come. And we'll just see how Metlife will be able to kind of offer or make offerings for these clients in the future. But yeah, that is a threat we just have to keep in mind.
Because the opportunity to grow up, it's really focused on market outside the US, because I can see that even revenue are quite flat last years. So since 2015 and so on. So the important point is to develop the new market and take advantage from them.
Exactly. I definitely agree. I mean, for a lot of companies, for a lot of companies I look at, I mean, this is about Metlife, so I'll not be mentioning many or others, but for a lot of companies I just look at how well we'll be able to adapt or maybe tap the emerging markets, the markets that are developing in Africa, South America. Those are just literally billions of people which are yet not using the product, you know. And by the way, there is a great book I could recommend. It's called Blue Oceans, and it's just about how businesses can kind of tap the untapped market, because most of the time, especially in the United States, businesses are focusing on how to kind of pull over the client from competition, right? And that is very expensive, and that kind of doesn't build customer loyalty. It's very difficult fight. And the book just speaks about like, how are you able to create or tap new market and kind of convert, they call it like unclient or not yet client, just people who are not yet clients. And those are basically not free, but it's just like a blue ocean without the sharks, you know, killing themselves. With the rats. So I think Africa, South America, Southeast Asia, those are the markets companies should focus on. And when I see that there's potential and that the company is looking at those markets and actively to engage there, that's a good sign. That's a very good sign for me.
I absolutely agree with this, and it's the fastest way to grow up, I think so.
Sure.
And I don't know what are you going to say, but I'm really glad to see a slide about management, because as a value investor, sometimes we are too focused on numbers, but maybe management is the most important things, and the quality of manager is the most important thing. So I'm really glad to see a slide like this.
100%. Yes. I mean, every great value investor not only mentions it, but puts enormous stress on it. The quote from the beginning I mentioned from Warren Buffett, buying excellent companies for a good price. I kind of cut a very important part, managed by competent or excellent people. And when I wrote my thesis, I spent a huge chunk of it, like how to actually evaluate management. And for an outsider, it's very hard, you know, because when we are, or I am yet very small investor in terms of my capital managed, and I just cannot really directly call the CEO like, hey dude, how are you managing your company? You know, it's not very possible. So I sort of have to just rely on the outsider information, secondhand information, so to speak. But when you have several good signs, I think it can put a like an overall picture, which gives you an idea whether the management is or has intentions aligned with the investors, and whether you can consider the management like reputable and the word kind of follow my I forget the word, whatever. So so one of the when you open the annual statement, they begin with a new strategy called Focus, Simplify, and Differentiate. I will not read the individual pillars of it, but they also really stress it that these are the new 3 pillars. And for a value investor, I mean, that's just that's a little dream come true, because they're focusing, they just want to focus their business on what brings the more cash flows, the most cash flows, what brings really what is the key of the source of the business. And they want to focus on that, which is great, because that means for the investor as owner of the capital, that they're not spending the money you gave them or you contributed to unnecessary things, which just means they're going to capture juicier margins and they're just going to focus on the important things. That is also regarded as simplified. They're really very closely watching their costs and the economy of scale. They just realize that for a company that size, it is just very important to manage that. And also for a company which might not grow 20% a year, the best way to increase earnings and free cash flow is just to be cost efficient. That is basically deliver operational efficiency, which you can read there. Deliver operational efficiency just means not spend that much. That's all it is. And then the differentiate, which is interesting to me because it seems contrary to the focus, but they are writing drive competitive advantage for our brand, scale, talent, and innovation. I mean, talent and innovation, let's be honest, that's all companies speak of, like our talent, innovation, know-how, all that stuff. It's sort of generic.
Yeah.
But what I see as important is the brand and scale. This is what we have been talking about the whole presentation, and they kind of realize or know it as well. I mean, of course, that just their brand and the size, the scale is what can help them just to capture the new clients and new markets and just be a more efficient company. So yeah, I think the strategy is great. They of course describe it more in the annual statement, but we could have a presentation just on that. And one sign, which is because the annual statement is from 2019, they haven't yet released their 2020 statement, but in September 2020, they actually sold their not very profitable and not very great property and casualty insurance business they actually had. They sold it to Zurich Insurance. It contributed only around 5% of revenues, but it wasn't their core business. It was just an attempt to maybe differentiate. They saw like, okay, this isn't working. Let's just sell it off. They got some cash from it. And I think that this really demonstrates that they're just sticking to the strategy. They're putting their the money where their mouth is. They said they're going to do something and they did it. And that's a great sign of management, to be honest. So that's great. Also, what I wrote, they reach or achieve very high disclosure score of 71. That seems very ambivalent. I use Bloomberg for my analysis, and they just do this disclosure score. I won't go over how they compute the score, but 71 is actually not the best one, but it's very high. It's just very high, and it's another piece of the puzzle that says, okay, this management might really be good and have intentions aligned with investors. And also I wrote they're very clear about its commitment in the future cash flows, shareholder value creation, etc., etc. So when you read the statement, you just get a sense of like, yes, they're speaking very clearly. They're not, because I have read several statements which were so ambivalent and you really didn't have a clue. Like, okay, what are they actually going to do? Like, I have no idea. I'm sorry. And that was a bad sign to me. But yeah, Metlife is not that case. Another sign. Yeah, go ahead if you want to ask.
Yeah, there is a lot of CEO that are really storyteller, and every time when you have earning disclosure, then you can see that the difference about what was planned and what is actually true. It's huge. Yes. It's really, really huge. So it's quite important to have a management that stick to the plan.
Yes, exactly. I mean, these storyteller, that's just the best way to describe it, Domenico, as you just did. It's just, yeah, some CEOs like grandiose plans, like how they're going to be more effective and capture more clients, blah, blah, blah. And then year after that, and you see like nothing's changed. And it's very disappointing and just not a good sign. Yeah, another sign or another thing I always look at is how much of the shares the management, the board of directors, maybe the founders just hold. The board of directors of Metlife together hold 15.3% of the shares, which is quite considerable. It's not, I mean, I would like to see it as high as possible, but there are companies in which the CEOs, the board of directors just don't hold any shares. And that is just very weird to me, because if you are a CEO of a company, and you should of course believe in the company, right? Because you are the one managing it. And you should believe like, yes, we are doing good work and this company should be profitable and should rise. Then of course I would like to hold the shares, right? It's just pure logic. And if the executives, the board just doesn't hold any shares, that's just so weird to me. And I kind of stay off these companies. Metlife isn't maybe the best example, but together they hold 15.3% of shares. So there's some considerable wealth in the hands of board of directors, the executive, and so on. So that is also a good sign. And also maybe a little nugget, but also the Metlife CEO, he opened the annual statement with the word fellow shareholders. And that is exactly what we've been talking about, like the principal agent problem, to have the intentions aligned. So that also indicates, like, yes, the CEO, the board, the execs are also holding the shares. They also consider themselves shareholders. That means they want to achieve the same goal as the shareholders on top of their executive roles. Meaning, yeah, if I'm a shareholder and I want to make money, the CEO that wants to make money as well. Simple as that. And I'm always a little wary of these statements because, of course, the CEO can tell you what you want to hear, right? That's also what the legendary investor Philip Fisher was saying. Like, do not fall in love with the annual statement or with the story the CEO tells you. And it's like, you have to just be wary. He can tell you what you want to hear.
Yeah.
Okay. But overall, I think, as I'm saying, it's very hard to judge from the outside, but I think overall management, scored quite good. And yeah, there's just no sign to be a mistrust in there. So let's take a look at the numbers. I'm still working on a format which would work best, because this is a little messy, I understand. But let's take a look at the first table or chart, the valuation metrics. And we'll talk about a little more, but the PE or at the time of the writing was very moderate. It's actually a double scale chart always. So the PE at the time of writing was 9.6, which is just very, very, very low. I mean, there are companies with much higher multiples. For an insurance company, it is, usual to have PE under 20 or even under 15, but 9.6 is still very low, which is a first good sign, like, okay, the might be undervalued. Then there is the average, but what is the biggest indicator to me, in this case, was the free cash flow to price, which at the time of the writing was 20%, right? And yeah, at first it's like, okay, so what? Well, that means that from the price of the company or from the market cap, think of it however you like, 20% of that they generate in free cash flows. And that is just extremely a lot, because we base our valuation on cash flows. And I'll spoil the surprise for you. The company has average cash flow, annual cash flow, free cash flow of 13 billion, 13 billion, right? And their market cap, if you remember from the beginning, was 42 billion. Yeah. What that means that in 3 years, on average, they generate 39 billion in cash flow. That is almost the whole market cap of the company, which means that in 3 and something little years, they're able to buy themselves back, which is just enormous amount of cash flow. I mean, normally, when I see free cash flow to price over 5%, that is just really great. That is amazing. And that's kind of my
minimum.
Yeah, exactly. The minimum is like 5%. If I see 4.5, but a company is good, I go with it. But 5% is just minimum. And when I see 20 or in 2019, and mind you, 2020, that was annual data accounting for COVID, and still they had so much cash flow. It's just amazing to me. In 2019, they had 36, 2018, 30, 2017, 30. It's just so much free cash flow.
So in a normal year, they will have a percentage around 30. Yes, but 2020 was 20 because of COVID effect. But exactly, actually, we expect in 2021 to be back around 30%.
Exactly. So it's just enormous amount of cash flow, and that sort of gives you a hint like, wow, this company might be severely undervalued. Regarding the profitability ratios, financial services companies are sort of special in that regard, but still, The return on equity has been rising annually. I have only 4 years, but it has been rising annually. Of course, in 2020 it fell down because of COVID, but still 8.4%. My like personal level is around 7% if the company is low debt. So the net margin also, you can see that as the gray line is also rising. So they're improving their margins. Actually, that is what we were speaking about, Domenica, right? That they're being cost effective, lowering their costs while moderately increasing or not increasing that much the revenues, but still they're increasing their margin, increasing their earnings, which is just great. Regarding the financial stability ratios, that is actually more complicated. The debt to equity is, of course, has risen also to 2019. I haven't included 2020 because the debt to equity was really skewed by COVID because the accounting measures taken were really weird and they allocated some of the liabilities at that, and it was really messy, so I didn't include it. It is a little higher than I would like to see, so that is a little con, which I didn't like. Still, it's a financial service company, so we expect the debt to be higher. That is normal. And their liquidity ratios are, I would say, exactly at the recommended values. So that is positive. And the growth rate. So I always include these. So the free cash flow growth rate, 10 years average, is 3.5%. For a mature company, which Metlife is, that is great. That is just, if the free cash flow grows at this rate, that is really positive. Then the net income growth is 7.7%, and that's very high, and that is exactly going back again to being more effective, being more cost efficient. Analyst 3 years net income estimate, that is estimate from Bloomberg, is around 6%. So, and that is again accounting for COVID, right? So again, I think very good expected growth rate for net income. And then a reinvestment growth rate is around 5.2%. That is basically based on earnings minus dividends and ROE, like how much they're able to grow if they reinvest their earnings at the ROE rate. So perfect. Yeah, and the revenue has been growing at 2.2%, which for such a mature company, I think is more than acceptable. So let's get to the fun part, to the valuation. So as I already mentioned, the company seemed like severely undervalued, and the discounted cash flow model showed that to me as well. So what I always do, I do not take the last year of free cash flow. I take the 4-year average because it sort of flattens out or normalizes if there is some spikes, for companies, for example, COVID, right? Because the free cash flow in COVID times were just not normal. It was abnormal. Or on the flip side, when a company has an abnormally good year for some reason, or just very high free cash flow because they sold off some business or whatever, it's just not normal. So I normalize it by averaging it out. It was per share basis 12.64. The short-term growth rate, that is always the struggle of a value investor, like how to pick the right growth rate. I like to be conservative, and we saw that the analyst 3 years growth rate is at 6%. The historical is 7%. The free cash flow is around 3.4%. And averaging those would be mixing like apples with oranges, which is not right. But I always go a little lower. That is I always try to go lower than the analyst, than the historical, and just try to get sense like what could be right, because mind you, this is for next 10 years. So I think 4% is reasonable for the year, for the free cash flows. The long-term rate, I usually set it at 3% because that is the historical growth rate of the economy and inflation together. But if you set it to 3%, you'll get ridiculous valuations, right? So I set it to 1%, saying like, even if the company grows just by a teeny bit, by 1% a year, what happens? And the discount rate I set to 10%.
Sorry, when you speak about a long-term growth rate, do you consider another 10 year or all life?
That's perpetuity. That's all life. Yes.
Okay, perfect.
Yeah, and then the discount rate, that is again another struggle for every investor, like how to choose the discount rate. And there are many many ways to think about it. That is the rate, or that is the rate or return I want to achieve, or accounting for the risk and so on. What I always do, like 7 or 8% is my minimum, because that is the historical average of S&P. So that is the next best investment, right? And I kind of stack on that like the risk, so liquidity risk, business risk, and so on. Metlife is not that risky, to be honest. So I would set it maybe to 8, maybe to 9% if I wanted to be super conservative. Yeah. I set it to 10% just to show you that even with a very, very high discount rate, the company is still extremely undervalued, and it gives us intrinsic value per share at 101, which is just 50%.
I can see that you have been really conservative in your calculation here.
Exactly. So because when I set discount rate to like 8%, I got valuations around 200, which is just ridiculous. And I mean, it's not wrong, right? Because discount rate is very subjective. It's not wrong. It's just, I just wanted to show that even if you are extremely conservative, you still get margin of safety 55%, which is just ridiculous, extremely high. And so, I think this first model shows extreme undervaluation. So maybe you can give me your thoughts, Domenico, on that.
Absolutely. I can see, as I just said, that you have been absolutely conservative in your calculation. So I can take for really right to have this intrinsic value up to $100. And so this margin of safety that is absolutely great. In my opinion, I can see that according to the high amount of free cash flow that this company have, for sure, if I was oriented in having a dividend from the company, this could be one of the best choice I can do.
100%. Yes.
Because I can see now it's dividend, it's around 3.5% or something like that, according to today's quotation. But it's really stable, and the company has potential to grow this dividend. And as long as this positive effect, we have the potential of growing in the market outside the US. So we have these two big positive way. And even at those price, we can still have a good protection with our margin of safety. So it's really, really interesting to evaluate this company.
Exactly. As you said, and with the free cash flow, I mean, it's very consistent. We basically said that the company at the current or at the cash flows we saw in the financials, it would be able to buy itself in 3 years, right? So this valuation isn't that surprising, because maybe to your viewers, just that's how I like to think about a discounted cash flow model. It's like just valuing or asking how much the cash flow has to grow at a certain discount rate to kind of buy the investment back, or sort of this logic. It's just like more elaborate in the steps in the calculation. And if the company has so much cash flows that it is able to buy itself in 3 years, then as I'm saying, this valuation isn't that surprising, and it's very consistent.
Maybe one question that could be raised is, okay, if I invest in this company, according to the fact that in the last 5 years, evaluation of the company, it's almost flat, as almost flat is the revenue. So they are increasing, but in a small way. Mm-hmm. What could be the factor that could push the price to $100?
Well, that is a good question, and honestly, I will not really try to answer that question, because that is more about I don't want to say speculation, but I'm not really good, or not even try. I'm saying like what could push the price. It's I mean, for sure there are people who can do it, and I mean probably you have your models or your approaches, how you approach this question. I don't, and I don't want to give you half-baked answers, or answers I'm not really comfortable with, or myself, or answers I haven't really thought through. So I cannot really answer the question.
Okay, we know that the market is not always aligned with the valuation of the company,
Yeah.
so it's quite strange to explain why the market is has those price. But for sure, according to the discount cash flow model, we can see that from the calculation, $100 is absolutely normal. Could be a normal quotation for this company.
Yeah, sure.
Really,
Yep.
thank you, Daniel, because you just show an incredible study. I know how much effort and work is needed to make such a study. So really, really thanks for sharing
pleasure.
this great study with us. And you are always welcome as a value investor to this channel because we really appreciate your work.
Thank you very much. My pleasure. And yeah, I wish you really successful picks and really successful investment in the future for you and your viewers as well.
Thank you everyone for watching this video. Please let's know your thought down below in the comment. Let's know if you are interested or maybe you are thinking about investing in Metlife or not. What are your pros and cons about this company? We can see on those channel almost every day with a new video. So thanks for watching. See you in the next video.